You probably heard the terms value and growth thrown around quite liberally in the investing world. And after 2 advanced degrees in finance and half my career spent at a company that practically invented the idea of value and growth, I can tell you that I know one thing for sure, and it's that everybody defines those two terms differently. So this is one of the oldest ways to describe the equities domain, and traditionally it's been thought of that growth stocks have the potential to perform better when interest rates are falling and company earnings are rising, also what they refer to as momentum. But they may be the first to be punished when the economy is cooling. And certainly you see that in today's bear market, how bad tech stocks have been taking a drubbing. And value stocks, these are often found in cyclical industries, and they may do well early in an economic recovery, but then they'll lag in a sustained bull market. So what's more important is agreeing upon a definition of how we can define growth versus value before we start examining performance. Well, for example, Schwab defines growth stocks simply as those with 5-year average sales growth above 15%, while they define value stocks as those with a price to sales ratio below 1. The point is there's a lot of different ways, and we'll talk about one of the more widely adopted methods here in a second, but I wanted to point out why this is important. So here's a very interesting chart. I believe this is also from Schwab that shows the Russell 1000 growth index minus the performance of the Russell value index. So you can see that when you remove value as a component, how dramatically that outperforms. But then when you start to include more companies, so you move to the Russell 2000, then it actually has the opposite effect. So these things need to be taken with a grain of salt. And one of the reasons why is that when you look at the sector weights here, you can see that affects how companies perform, right? So here on the far left, you can see that information technology in S&P 500 growth is significantly overrepresented, whilst in value, you can see utilities, energy, materials, staples, real estate, those are all overweight and represent less growth traditionally. So it's very important to consider sectors when you're thinking about value versus growth. Now, a very objective way to look at things would be to use this multi-factor approach. So this is what MSCI uses. They're the global index provider, the leading index provider globally, and they were the first when they acquired Barra to incorporate factor indices that used value and growth. Here you can see they've taken 3 factors to describe value: book value to price ratio, 12-month forward earnings to price. I'm not going to go through these. You can see also below that 5 factors they use for growth. But what's interesting to take away from this is look at the chart on the right. There you see quadrants 1 and 2 that I've highlighted. That's where you might have a pure value company on the upper left quadrant, or on the bottom right quadrant, a pure growth company. That's not how things work. So how MSCI goes through is they examine the entire population of stocks, and then they give them exposure that equals 1. So it may have 40% exposure to value, 60% exposure to growth in those respective indices. So you can have a stock that has that resembles value and growth by a certain proportion. So that's important to think about. Now, today we want to talk about a different type of growth. That's disruptive growth. This is what we look at when we're investing in our own disruptive tech stock portfolio. So disruption is driven by advancements in technology. So we can assume that a lot of disruptive stocks belong in the technology arena, or at least utilize technology. They may not be classified as such according to industry classifications, but disruption is all about either displacing existing market share or creating new market share, what they call blue ocean market. So capturing market share is the ultimate goal of a disruptive growth company after surviving. So if they're not capturing market share or growing revenues, that's a proxy for market share. captured, then what's the point of investing in that firm? So we would say that, well, growth must exceed at least inflation. So a common ballpark estimate of inflation is around 3%. Let's say, to make things easy. So when you're analyzing disruptive growth firms, you can't use the traditional analysis that surrounds earnings. If you look back at MSCI's various factors, all of those were about earnings. Well, when you're a disruptive growth company, you're typically not having any positive earnings. You're just capturing market share at all costs, albeit in your efforts to also survive. But the focus there is on growing revenues. So today we're going to look at an example of a company that we want to consider for our own disruptive tech stock portfolio. We want to figure out, are they actually disruptive? So the thesis here is quite simple. Water is the new oil. We can all understand that. The amount of water on our planet never changes. It actually stays the same, but the availability of that water changes. So we can use Internet of Things technology to revamp the archaic water infrastructure around the planet. And we can do good in our performance, our investment performance, while doing good for the planet. That's ultimately what we'd like to see. The truth is that in most ESG investments, it's more about doing good for, let's say, subsidizing problems that exist. That's not how you fix big problems. So the company is called Xylem, and you can see here that they are relatively large. Their market cap is much smaller now, more around $17 billion. So it's fallen quite dramatically, as most stocks have since the beginning of the year. But this is a great slide that shows you their geographic footprint, where they operate, their revenue profile. So they're dabbling in water infrastructure, applied water, and MNCS. I can't actually recall that acronym, but it relates to water. And then you have here the end markets they target, mainly utilities, then industrial, commercial, and residential. So it's easy to understand with the water crisis, if you will, the need for investing in firms like this, or at least the opportunity. So here you can see the main points put forward by the company as to why we would want to invest. And they're looking at expanding their digital portfolio. So think software as a service. They want to expand that by 2025 to 50% of total revenues. Right now it's 35%. They want to grow in emerging markets where water supplies can be problematic. They expect to see a lot of growth there. And then you see here they talk about improving their margins. So when we consider the revenue growth that they're going to realize, it isn't so grand. So you could see here 4 to 6% organic growth, compound annual growth rate going forward. And, this margin expansion, of course, and these other metrics, but it doesn't relate to revenue growth because that's not what they've historically focused on. Here you can see we've taken the 10-year revenue growth is at 3.17%. That's almost exactly what global inflation was in 2020. So that they're not growing revenues more or less if they're just growing at inflation. But if you add another couple of years, they move to 6%. So remember, you can always torture the data and make it tell people what you want. So but just looking at this, right, 5-year, 10-year revenue growth, and based on what the company tells us, growth of revenues isn't a big priority. And here we've kind of spelled out revenue growth at a quarterly basis. So you can see that it's just sort of bouncing around there, but not doing anything grand. So the fact that we don't have strong revenue growth here is a problem. And when it comes to investing in disruptive technology stocks, just based on this criteria, very simple, of the need for strong revenue growth, we don't see that. So by definition, a company without meaningful revenue growth can't be disruptive. When you're looking at disruptive companies, so you're doing disruptive growth investing, you can't use traditional methods like valuing using price to earnings ratio. That's not going to work. What you want to focus on are two things: revenue growth and survivability. So when you're in bear markets and they need to continue fueling their growth but don't have access to the capital markets like they used to, then we want to make sure they had enough cash. They made hay while the sun shines, so they're not going to run into problems. So this firm wouldn't belong in our disruptive tech portfolio because it doesn't have the revenue growth that would make it a disruptive growth investing stock. So please put any comments in the comment section about your approach to disruptive growth investing. Make sure to subscribe to our channel, share this video with your friends, and thanks for taking the time to watch it today.